Inflation hitting its highest level in, get this, 41 years. June's consumer price index shows inflation rose more than 9% from last year, and that's higher than economists expected.
The U.S. economy keeps climbing an inflation mountain and thinking it's reached the peak, only to find the peak is higher and further still. A much higher headline, of course, CPI numbers showing the inflation peak remaining clouded and raising questions about just how high it will go and how much the Fed has to do here.
The Labor Department report showed the CPI rose in June on both a monthly and annual basis by 1.3% and 9.1% respectively. The data showed that inflation in the United States was running at its fastest pace in nearly 41 years. Now everyone is worried that the Fed may act even more aggressively than expected to cool the economy. In today's video, we're going to cover Cathie Wood's alarm bells on the economy and why she thinks the Fed is making a big mistake. Stay tuned as she states that we're in a danger zone. Before diving into the video, don't forget to subscribe to my channel for more videos like this. You can also hit that bell icon to never miss a video.
The Fed right now is much more worried about its own legacy than it is about the economy. It is so afraid that it has let the inflation genie out of the bottle and that it won't be able to get it back, that it is in unison basically going out there and saying, we are going to tighten. We have an unconditional commitment to 2% inflation. Well, I'm going to be sharing with you a lot of indicators that will suggest that using the CPI as its guide, the Fed is making a big mistake. There's already a lot of deflation in the economy. And one of the reasons the deflation is accelerating here is because the Fed has shocked the system. We have gone from 0.25% in the Fed funds rate to 1.75% in the span of 3 months. That's a 7-fold increase. We've never seen that before.
The world is facing a number of economic challenges at the moment, and one of the big questions on everyone's mind is whether inflation or deflation is a greater risk. Now, on a macro level, Cathie Wood sees deflation as a greater risk than inflation. She criticized the Fed's role in recent monetary actions. She points out that the Fed doesn't seem to have picked up yet on various market signals, consumer sentiment, flat yield, and rising credit default swaps. According to her, there are a number of signals out there to watch out for, indicating that we're in a danger zone. Let's hear her out more.
One of the most obvious, but one that very few people mention, or maybe they don't monitor, are credit default swaps, CDSs. Now, this is the price of insurance against bankruptcy. And so when the price of this insurance goes up dramatically in a short period of time, I certainly take note. So the 5-year CDX, as measured by Markit, M-A-R-K-I-T, has gone from 50 to 100 year to date. And for JP Morgan, so a money center bank, it has gone from 48 to 102. So JP Morgan's credit default swaps have gone up more than the market's average. That's very interesting. And we're trying to figure out what is that all about? We know that JP Morgan is a fortress. It's not going bankrupt, but there are some investors concerned. Or concerned that there might be something systemic going on. And so why not take out the insurance? Now, 102 is quite a bit below 0809. We were at 239 then, and below COVID, 172. But it is above where we reached in the fourth quarter of 2018, 80. That was a vicious market downturn in only a quarter, 1 quarter's time. So I think it was from September to December. So this doubling in credit default swaps for the market's average and JP Morgan has us asking questions. Is there something systemic out there? Our guess is that if there is, it has to do with the reach for yield that we saw during the last few years as interest rates went effectively to zero on the short end and as low as 0.5% for the 10-year Treasury bond yield during the coronavirus. Now, reaching for yield, if on top there's leverage, could be a problem. Now, one of the reasons we don't think this is going to be a problem is because of what happened a little more than a year ago with the Archegos blow-up.
Cathie explains that credit default swap is one of the most important but often overlooked financial instruments. She always takes notes of them whenever their prices go up. She also states that JP Morgan credit default swaps have gone up more than market average. She further added, when we see something like this doubling in credit default swaps for the market average and JP Morgan, we have to start asking questions. Is this a warning sign that something is about to go wrong? Is there something systemic out there? What does it mean for the economy? According to her, if this happens, it has to be with the reach for yield. Want to know more about it? Stay tuned and also give this video a big thumbs up if you haven't already.
Apparently, one bank didn't know the amount of leverage that Archegos had taken on, and this was true across the banking system, and so that's how that situation became so leveraged. I think risk officers are now looking for excessive leverage, and so we would be surprised if there is going to be a systemic risk, but we do want to note that the concern is out there and it is elevated. Interestingly, and speaking of JP Morgan, the head or the chief investment officer of its asset management unit, by the last name Michelle, came out yesterday, and I found it difficult to believe, given that he's right in the middle of the bank. But he basically said, the Fed had waited too long, and now it's going to have to work that much harder to get inflation under control. And, I think he's ignoring an incredible number of signals, the first of which I've just shared with you, credit default swaps. The other one is the yield curve. And I know I've focused on the yield curve on this webinar many times. It is flat. It did go negative for a time in April. We've never, in post-World War II experience, seen the yield curve invert without a recession.
Cathie Wood stated that she has never seen yield curve inversion without a sign of an impending recession since World War II. Cathie's comments come as the market continues to speculate about the Fed's next move. The Fed has been saying that it is monitoring inflation closely, and this data will only add to their concerns. Many believe there are chances of a 100 BPS hike in the July Federal Reserve meeting after this hot CPI data. Do you believe that the Fed is going to take that step? Have we now seen peak inflation, or are there more surprises ahead? Let me know your thoughts in the comments below. And to always stay updated with the latest news on market and economy, be sure to subscribe and like. I'll see you all in my next video. Adios.